Welcome to the Entrepreneurs at Scale podcast, the show where we go behind the scenes with founders, operators, and deal makers to unpack what it really takes to build enterprise value and scale up organizations. Today, I'm joined by Rob Follows, the founder and chairman of STS Capital Partners, expert guides to entrepreneurial business owners on the journey to achieving what they call extraordinary exits. Rob's past spans entrepreneurship, marketing, leadership, and purpose-driven work. And in this conversation, we'll dig into what an extraordinary exit looks like and why having the right exit advisory team can be the difference between a good deal and a great one. Rob, welcome to the show.
It's my honor and pleasure to be here, Neil. Thank you. Thank you.
So let's dial back on your entrepreneurial journey and really before STS, you built businesses and you led in different environments. What was the headline version of your entrepreneurial journey that brought you here?
I think that, first of all, it was a blessing in disguise. My father threw me out of the family financially at 18, and said, "I'm throwing you out of the family because you're not going to work for me. So you'll come crawling back and want to be part of the packaging machinery business," which I couldn't stand. I love people and marketing and strategy. Neil, I said I'll never come crawling back. I got two jobs to pay for my school, and eventually ended up working in. Actually, we were just earlier talking about Alberta, Canada, Banff, Alberta, Canada, with a group that went bankrupt because I was the sales guy that sold too much. And that was a lesson to make sure the supply lines are solid. I assumed they were. And the
Yeah.
CFO went to a marketing services agency and she said, "You've got to come join us." So that was my first real ultimately entrepreneurial undertaking because I joined that group and then they were leveraging the relationships I had up there as I'd spent the whole summer there and had skied with them in the spring. And then I moved back to Toronto to go to university and because I didn't want to drop out, and started a branch of the business there. Very soon after that, I got credit from all the suppliers on the condition I would sever the relationship with the headquarters that wouldn't pay the suppliers. So I was not quite 20 years old and I had millions of dollars of credit from the suppliers because I had all the client relationships in Toronto, which I'm very thankful for. And many of them with very conservative organizations, the great brands, all the life insurance companies, the trust companies, and some of the banks. And so in time, what happened is an advisor said that the North American Free Trade Agreement was coming along, and they couldn't give protection to this business, and therefore I needed to sell it. And I'll tell you, Neil, I tried to find an entrepreneurial, supportive advisor, and I'll get into that later, but I could not find one. I could not find one. And so there's a lot of lessons in that and selling the business. I left 75% of the money on the table, which I'll talk about later. And I also ended up joining the world's largest business in that sector. And I stayed there for 10 years. So I have the entrepreneurial background, the selling of my business background, where I got 27 times EBITDA. I thought I was just the luckiest guy in the world, but later found out they would have paid 100 times EBITDA, which was crushing to me. I was like, what an idiot. I left 75% on the table. How could I? And later, I ended up spending 10 years with the buyer who was the largest in the world and running $1 billion of their business, as we call YPO, a hired gun. And then I ended up doing a PhD at Oxford in strategy at the same time I was working, which was breaking the rules at Oxford. And they eventually asked me to go to Harvard because they didn't want me with my accent there. It wasn't proper. But I learned there that from an academic standpoint, that they didn't understand and wouldn't teach what I'll talk about later, which is integrated value. And that's where the combination of having been an entrepreneur myself for 10 years and built up a business, having sold it, I left 75% on the table, becoming the buyer for 10 years for a strategic and understanding that. But all through as an operator, I thought I'm going to start STS Capital with all of that background to help entrepreneurs get the true value of their business and families as well. Because the whole system stacked against them, Neil, as you probably know. So yeah, that's a bit of the background. I can go deeper in any area as you
Well,
wish.
you mentioned Oxford University. That obviously explains why when we first met was at the Oxford and Cambridge Club, where I
Right.
obviously learned a key lesson, life lesson about planning is very important when you go to such noble establishments. As you will know, that I was asked to either leave or put a tie on. So I did
Sorry
put
about
a
that.
tie.
It's happened to me too.
So you had a number of businesses, there was sort of Active Impressions, Marriott's and Ultravest. What were the
Yeah.
2 to 3 biggest lessons you took from scaling them, positioning and purpose? And how do those show up in the way that you guide founders today?
Yeah, well, first of all, I think what the most important thing I could share in that area, Neil, would be to be clear on your vision. So I've just written a book called What is Your Everest on 7 different ways of life planning, but really, and the 4 steps to get through your fear. But the most important one is focusing, to answer your question, on your vision and staying committed and sticking with your vision. It's really hard. Entrepreneurs get pulled and families get pulled when they go to new businesses, all different ways. But sticking with your vision and understanding the value that that creates for who in the environment it creates is really, really important. In my case, I developed a business in Canada that people didn't understand. But when the advanced American, much larger businesses saw it, they said, this is exactly what we're doing. And I thought I was upstream all the time fighting. There was nobody else doing it in my little marketplace in Canada. But I stuck with a vision. And staying with a vision, I ended up with 27 times EBITDA. Staying with a vision is really, really important, and being brave and scaling. You get knocked back a lot when you're scaling, right? You hire the wrong person, a client quits, things happen. But being brave when if you have a vision to scale and staying with it is and being humble through that process, because you hit highs, but then there's inevitably, as they say, fortune's wheel turns, there'll be lows. And so sticking with your vision, being really clear on that, and then being really brave when you're scaling, and then understand your value to the different constituents, right? To your employees, your executives, and your clients, and really remember that you are the value for them as the leader of your business, and therefore you've got to be true to it. And and your vision is so important to all these people, and so that's what I'll finish up with. I think that's probably the number one.
Yeah, and we've got a mutual friend in Cameron Herald who's got a great resource called Vivid Vision, which
Yes.
really helps you get clarity in
Yes.
short term anyway about where you see your business in 3 years' time, and
Right.
really powerful. To your point,
I could,
really the importance of getting
I could,
clarity.
I could share, a humble example. The
Yeah,
branding for STS is success to significance
yeah,
through selling to strategics. Because I firmly believe in my heart, if we can double or triple the value of a business in the sale process, that entrepreneur, that family will have that much more capital, and ultimately you're not taking it with you when you pass on. So creating legacy, creating philanthropic outcomes, which are very important to me, just personally, to help make the world a better place, is just a passion I have. And so I was afraid of sharing that, to be honest, when I came out
oh,
with it. So I went out with STS selling to strategics. And then
yeah.
somebody challenged me really hard and said, that's a piece of crap in a YPO forum. And I know, sticking to your vision, it was my vision. And I had to be brave. And so, I said, you know what? I quit the forum. I quit this because you're not values line with me. And you actually have reminded me how important this is to me. And while I might get laughed out of many boardrooms in New York, I'm going to New York and I'm hiring a partner in New York, and we're going to push this right in the heart of where the world's emanates from, which is New York City. And so I did that, and we didn't get laughed out of boardrooms. We ended up getting
No.
embraced by people that wanted an advisor that cared more than just for the greed factor that you see so much in New York.
Yeah, I love that, and I think this whole notion of being purpose driven and true to your spirit around that and your vision. So you talked a bit about sort of setting up STS Capital Partners. What was the real pain points that you saw in the marketplace that founders had and stuff like that that really drove you to make this difference?
Yeah. Well, I know in my bones that because I've been doing this for 30 years. entrepreneurs and families aren't well represented out there. They go through their, they're building their business, they're building it up, and then it's time to sell for whatever reason. And private equity and VCs are looking for the 6 Ds: death, divorce, disease, disability,
Yeah.
disenchantment, disintermediation, or too much debt, and so the entrepreneur, the family business owner, if you go to Goldman or you go to JP Morgan or you go to any of these guys or even the mid-range guys, they're doing business with the buyers all the time, especially the private equity buyers. They're not doing business with the sellers. And so that's why I had trouble finding a representative for myself with my really unique business when I went to sell my business. And so what I know to be true is that entrepreneurs and family business owners have to look very hard to find representatives that care about them, are not conflicted, and will only represent them and not be wooed by the buyers, promises of more deals for them and more. If you're a very large investment bank, you can't afford not to get deals back from private equity. So you're compromising the sellers. And I feel that the sellers deserve to have somebody that will only represent them. And I hope that will create, I know it will, which we'll talk about later, but 200 to 300% more if you sell
Yeah.
to strategics than private equity. And that can create freedom and more opportunity for legacy for families and entrepreneurs, Neil.
And of course, we all know that most founders, business owners, probably the first time they ever have any sort of instinct about an exit is when some sort of outreach comes from a private equity company, and they say, "Well, we'd love to buy your organization."
Yes.
And there's obviously thousands of private equity companies, and they're very sophisticated at this. And most, I would imagine, Rob, are totally naive around what other options there are, and,
Right.
and would have no idea that there are
Right.
people on the sell side who are really, really gunning for them.
Yeah, and there's not many of us.
No,
Really, there's not. And so it's a challenge because the seduction of the private equity and the industry leaders, if you're an industry specialist, is very powerful. They're offering you multiple deals, and meanwhile, a family and entrepreneur is offering you one deal. So
yeah.
you got to find people that are totally committed to supporting families and entrepreneurs, and that can lead you to double your price, Neil, which we can talk about later.
So you're all about extraordinary exits. Rob, what makes an extraordinary beyond just the valuation number?
So I teach a lot of M&A, Neil, in different places, and I recommend this for owners and entrepreneurs. You start off with an owner's outcome exercise. Like, what is it that you must have? So they're the must-haves and the nice-to-haves. So what are the must-haves that are required outcomes of this strategic transaction? And then what are the preferred outcomes, which are the nice-to-haves? And Neil, then once you've done that, and it's very, very important for all the stakeholders that are involved in the transaction to do that. Once you're clear on your required versus preferred outcomes, you then know that the only people you're going to talk to are those that tick all the boxes on your required outcomes. And because that defines the extraordinary exit for the entrepreneur or the family business owner, then the answer to the question is if you can achieve all the required outcomes and then all the preferred outcomes. So we had clients, for instance, that had a $50 million pound euro, outcome that they were looking at 50 million, and they ended up turning a deal down at 250 million because they weren't clear, they weren't crystal clear in their minds what would be an extraordinary exit, and they lost the deal. And so having a clear view of what your required outcomes are and your preferred outcomes allows you to negotiate better,
Yeah.
and it also supports, if you want, your oldest, manager to stay there for the next 10 years, you put that down. If you want the name of the business to stay, you make that either preferred or required. If it's required and the buyer won't do it, then they're out. If it's preferred, then we're trying to push the buyer to do it while they lock in all your other required outcomes. And so an extraordinary exit is different for every person based on the required versus preferred outcomes in what we call an owner's outcome exercise. But to make it one sentence, the answer is something that knocks the ball out of the park in terms of the vision the entrepreneur, the family owner had for their exit, giving them the freedom to create the next chapter of their life.
In your experience, what are the most common myths founders believe about exits that really cost them value or opportunity?
Yeah.
Sorry, optionality.
Um, there's a lot of them. first one I think that people will hear, to your point, where private equity is reaching out and calling people all the time. The first myth I'd say is private equity pays more than strategics. That's not true.
Hmm.
And I could go into why, of course, and go deep into that, but that's just not true. It can't be true, by the way. So because of the structure of the industry, which I could go into if you like. Number two, VCs are not your friends. I have so many tech entrepreneurs and others. I run the tech exits for YPO as an event, and they come up and say, I got XYZ to set me to buy into my company. I've made it. I'm like, tell me again. That's a VC. That's from the Valley in
Yeah.
California. And they're like, well, yeah, I've made it. I'm like, no, no, this is the first nail in your coffin of ownership. And they'll look, you're negative. I'm like, because I've lived it. I've sat down with entrepreneurs many, many times where the tears come out when they realize that they don't own the business anymore, even though they think they've got the common stock. There's a pref share class over their common stock that takes all the upside away. I had one entrepreneur and she was worth somewhere between $3 and $5 billion. And she was a global business, so it could have been any currency, but she was in Southern California. And she gave us the mandate. We had the mandate and we're like, this is fantastic. Why won't your board meet with us? When I finally got to the board, they're like, I don't know what you think you're doing. There were a bunch of VCs. She doesn't own the business. She might own the common shares, but she does not own the business, and she cannot decide to hire you, and your contract isn't worth the paper it's on. And she'll work for as long as we darn well, they used a different word, but
Yeah.
darn well want her to. And so the poor woman was stuck. And I had another one that I'd met in Puerto Rico because it's the only American tax haven really, if illegally. And so he was very excited. He had developed this transportation business, last mile, and it was fantastic. And I was up in his hometown and about to visit with him. Before I come visit with you, can you send me your documents from your investors? Because I just want to make sure that I'm visiting with the guy who owns the business. How could you possibly say such a thing? I'm like, well, I've been around the block a few times. Could you please send them to me? Because you said you've got a private equity group on your cap table. Yes, but they just have a minority. I said, I understand, but can I please see the documents? And when I read the documents, the private equity firm had invested in around $100 million valuation, which made the entrepreneur very excited. But in the document, it said that they had no choices on any strategic initiatives, Neale, any sale of the business, anything until they hit a $560 million valuation, which was, nowhere near sight. So I didn't go and see him. I said, I had to tell the entrepreneur, I'm so sorry, but you're not in control of change of control. You can't hire me. And I've seen one other story I'll tell is an entrepreneur that went into the VC world, and I met with him. It was in Los Angeles. I met with him in big boardroom, very fancy offices. And I said, before we start the meeting, I just want to know, like, how much do you still own of the equity? Because that's what you're retaining us to sell. And it was 7%, Neale, 7%. And I said, I'm sorry, but I have to leave. We can go have a coffee if you want, but there's no discussion on you hiring us to sell your business. Like, what are you talking about? I control it. I'm like, I'm so sorry to say you don't. What these venture capitalists do is fuel the ego of the entrepreneur or the family, but they take away all the control. And so the second one is VCs are not friends,
Yeah.
although they're very sophisticated and very, very smart and very polished. They're not your friends. Um, uh, Confidentiality. If you're dealing with strategics, the third one I would say is confidentiality. You have to be very careful of. You don't want this getting to your employees or your clients, obviously. And that you would think everybody signs NDAs. Those are not very powerful. I'll just say to be polite. Some people would say they're not worth the paper written on. That's not quite true. There's been
Yeah.
some legal cases, but strategic buyers will honor the confidentiality because they don't want the competitors to know what they're doing and they don't want anybody to know. They want to keep it quiet and get the deal done if they can. If you're private equity or VCs, you're not an operator. So you need to get the operator's view of this. So you start sending this out to operators that you know in the industry, and that starts a rumor mill. And that's a problem. So with confidentiality with financial buyers, whether they're SPACs or they're private equity or VCs or strategic operating funds or fundless sponsors, whatever they are, they're all the same. They're all using other people's money to buy low to sell high. Those people cannot afford to be confidential in the industry because they're not operators. They can't assess it effectively themselves, Neil. So confidentiality will not be honored, although you might not know about it, by financial investors.
The word sophisticated by the PE or VCs. They're doing thousands of transactions day in and day out. And of course, we know that most founders and owners, this is their first time at the races.
Yeah,
So they do not have a playbook, let alone a sophisticated playbook. So,
right.
the odds are all stacked against you
Yes,
in so many respects, even though you're right. They make you feel like they're the best friend and, they've got everything in terms of getting the psychological
right.
upper hand.
Yeah,
They've got every single trick there. So
yeah,
we started off talking about the owner's outcome exercise, which really
yeah,
is really important because I guess for a lot they haven't really thought about what a great outcome looks like. What then
yes.
do you then see as sort of the biggest controllable drivers of exit value that you
Hmm.
focus on, and you're helping people gear up for an
Hmm.
extraordinary exit?
Hmm. Well, Neil, so the drivers of exit value are based on the integrated value of the strategic buyer. Okay. Whether or not you're selling to private equity who's going to grab it and resell it, it's
Yeah.
still driven by, I mean, I would advise not just go straight to the strategics, right? But the integrated value. So let me just try to describe that. You're a big strategic operating company, and over here is your small, business you're selling. The question is when you put that business inside the large strategic the buyer, how much money will they make owning it? I mean, that's the big question. Ask yourself. And how will they do that? And an operator that's been a buyer, like all our guys have been sellers and they've been buyers, as strategic buyers. Because you have to understand how is this strategic buyer going to think about this integrated value? And what drives that? Is it a product? Is it, and we'll get into Rembrandt's later, but this is part of that, touches on it. Is it a product? Is it the IP? Is it because they've got a geographic location and distribution network? I mean, it's different for every buyer, but what you've got to get to is the driver of the exit value is what the strategic buyer will make money on when they integrate it. Okay. And so the way to maximize that is by getting in front of, which we can talk about later, getting in front of strategic buyers early and finding out what drives them and then steering to the one you like the most. Because that's doable if you have somebody like us to get you in front of the strategic, say 2 years before, Neil, and your
Yeah.
coach helps you and we get back from the strategics what they're looking for, and then us giving some direction, your coach giving you, a lot of day in and day out support on how to fulfill those things will drive the value.
So why do strategic buyers often pay more than financial buyers, Rob? What do they really
Yeah.
find that creates the premium?
Yeah, that's a great question. Um, so the way the world was structured in this industry, if you go back, like when I first started, there weren't many private equity firms. There maybe a handful. There were merchant banks in London, as you know,
Yeah.
but there weren't these financial short-term thinking, financially driven groups. And so how it developed, let me try explaining it this way, please. If over here is your private business, it's your private
Yeah.
business and you've developed it, you know that business really well. What you don't know is what the market looks like outside of that. And I would distinguish it between middlemen financial buyers and strategic buyers. Originally, there was only all of these operating businesses and strategic buyers. You would call them trade buyers in England. And so the what happened over time is these really smart Harvard graduates, and now they're producing fundless sponsors, which is another whole area I can talk about out of Harvard the last 5 years. The middlemen were created. They created the space for themselves to buy from these unaware, uneducated in this area because they know their business really well, like all of us do as operators, but we don't know the whole dynamics of the whole global marketplace in the industry or in industries that are adjacent. And so that's the value that private equity says, and these other financial buyers, VCs do, is they become middlemen and they say, I will buy well, but they don't tell you that. They say, I'm going to give you fair value for your business, 5 to 7 to 12, whatever it is, times EBITDA. And then you're going to keep 20%. You're going to keep running the business. I'm going to dump tons of debt on it so I can leverage my equity. And then I've got these theses. And then, by the way, they go and talk to the strategics before they make the purchase, Neil. They go and talk to the strategics and say, if I have this ready in 2 years or 5 years, what's going to drive the value? And then they
Interesting.
have the thesis, they go and get other people's money and they buy the business. Well, let's just pause for a second and think about that. If they're buying low, using other people's money to create margin to sell high to a strategic, who's going to pay the lower price? Like if you just think about it, basically, they have to pay less in order to make their margin. Now they do a lot of other things to make their margin too. They're smart and they add value. You know, they hire McKinsey, they do other stuff,
Yeah.
which is all true. But fundamentally, they're reselling to a strategic. So if you cut out the middlemen, Neil, and go straight to the strategic, you'll get that higher price. What you need though is somebody that understands the strategic as an operator and can talk their language. That's what's missing from a lot of advisors. If you're an operator, you can talk the language of the strategic. You can get them to open the kimono, Neil, and share what they're going to do with it. Why do they do that? Because you create fear in them. You don't want to mess this up, do you? No, a corporate executive, that's the one thing they never want to do is mess up an acquisition. So they're willing to open up the kimono and show you how they'll integrate it if you speak their language. So then you see the value and you negotiate the value up, and they're happy to pay it. It's not their money, Neil.
Let's turn now to your search for a great potential, a strategic buyer. And I guess the analogy here is that if you're selling a house, you're much more likely to get the value you're looking for. You've got four or five very interested parties who are wanting to buy your house and doing that. That creates that competitive tension. What do you do in order to find the right strategic buyers? How does the STS process work around that? And then how do you create the tension? Yeah,
So in terms of finding strategic buyers, we create a mind map of all the different vectors, Neil,
yeah,
of the different potential strategic buyers, and through mind mapping, and we do it on our own, and then we do it with the client and their coach, and we map out all of the ones we see as strategic buyers, and then we use our experts in the industry. So we have 7,000 advisors that are contracted with STS, and we bring in industry experts, and then they expand we see how far we can get. Then
yeah.
they expand the mind map to all different areas they see as valuable, and then where they'll see value. And then we take it to industry. We go out to industry, potential industry strategics. And when they decline, we ask them a very important question. Okay, so why are you're not able to do it because you just made an acquisition and you're integrating that, we understand. But if not you, then who? And so people from China, people from Japan, I mean, that's where we're going, right? We're going to the Middle East, to the Nordics, to North America or Europe, depending where, and we have many clients actually even in Africa and in Asia. If not you, then who? I was speaking this morning to a multi-billionaire from India who's 85 years old, and I'm like, are you still buying? He said, absolutely. And I'm like, okay, then give us the profile, so we keep profiles on all these different strategic buyers that we're talking to every day. And then once we have that map, that map that we've created, the clients contributed to, their coach contributed to, our industry expert contributed to, and then we're out in the initial marketplace asking people in the industry, if not you, then who? We have a map of hundreds of potential strategic buyers. But remember, they're global first. You don't go to your local market first because you don't want local competitors to know. You go to the global market first and narrow in.
So, right at the beginning of the call, we touched on a concept that you and I have been working for many of our clients for a while, the Rembrandts in the attic.
Yes, yes,
So, let's start back a bit. You and I know what it means, but just give the analogy of how that
sure.
Rembrandts in the attic works and why it's such an important part of
Yes,
matching the value when it
yeah.
comes to selling a company.
No, for sure. Absolutely. So a Rembrandt in the attic is an analogy, and to just go through the story, your spouse comes home and says, I've found the house I absolutely love. And you say, well, how much is it? And your spouse says, $10 million. And you're like, but it's on Main Street. The houses there are 5 million, or pounds or euros or whatever the currency is, rupees, pesos, whatever it is.
Yeah.
And you say it's twice the price. Why? I don't even want to go look at it. And your spouse like, no, you need to come and see this. It's fabulous. So you see that, yes, it's beautiful, but you're in the back of your mind, you're like, I can't agree to this. It's twice the price. So you say to the real estate agent the obvious question, why is it that this is twice the price? And he said, because they absolutely love it. It's absolutely beautiful. It is all of that, but everything else on the street is at 5 million. And so why would you think we could possibly justify this? I haven't got the answer, but there's a lot of really cool machinery in the basement, and there's a whole lot of stuff up in the attic that you might want to go look at, and it all comes with the house in case any of it's of value to you. You check the machines out, they're not, you go up in the attic and it's a bunch of dusty stuff, and you pull a cover back and you see a whole row of paintings, and it's got the R and the T in the bottom right hand corner, and you're thinking, this couldn't be. This looks like one of those Rembrandts I've seen in a museum. This is no way. So you call Christie's quietly, get them in the next visit, and they confirm it's not just one. There's a row of them of different artists, and so that those are worth $50 million at least. And so you go down to the real estate agents; they all be happy to pay 9.9 million for the house. So take that analogy then and apply it to businesses that are being sold. The seller has been operating the business. We're dealing with one now in semiconductor and deep tech that's been developed in Mexico, and they haven't got into the mainstream yet in California. And their value will be what they've developed with all their engineers. They've got fabulous engineers that hasn't been yet developed that can be integrated, as we talked about earlier, by the strategic buyer who will value it at an exceptionally higher value than the person that created it. So it can be products like that one. It can be IP, but that's part of too. But with IP, you got to make sure, by the way, you get the sign-offs from all your engineers, by the way, anybody in the tech business, because that becomes an issue on the IP. Because as soon as they see you sell for millions of dollars, the engineer's like, wait a minute, I developed that, and I don't think I gave away all the IP. So please make sure any of you that think you've got IP as a strength that you've signed off, all the engineers have signed off on that, because that becomes difficult in due diligence. It could be distribution. We've got a great story in Poland where there was a bakery being sold, and there was a classic German, the largest bakery in Germany would love to buy it. And so we went under our value backs process, which we can talk about later, and went to see the bakery in Germany and said, this is for sale. So we understand. Would you like to buy it? Yes, we want to buy it, but it's not for sale now. We don't think it's worth enough now. The client has a goal. What would it be worth now to you? And they're like, oh, we're not playing that game. It's okay. Then tell us what the Rembrandt would be for you, basically. Like, what would you view as being a value? And they said, well, distribution. We would take our top three products and we would distribute them across the pole, and we would take their best couple products and distribute them here. And so we're like, okay, so your top three products distributed is not equal to EBITDA. They said, exactly. We don't care about EBITDA. We're going to measure it on the profit of our top three products times all the distribution trucks, lines and routes that you have, that we would multiply out. So then we got our client to take all their profit and put it into trucks. And that drove the value to double the value that they would have had, because they put millions of dollars into many more truck routes. And that's what the Germans wanted. And so that's an example of the Rembrandt. And also, when you talk to strategic, sometimes it has nothing to do with EBITDA. Like when I sold my business, obviously I got 27 times EBITDA. It was because of the distribution we had that we could switch on for their largest client and protect their IP. That's what it was about. And their $300 million of profit they made with General Motors at that time. That's what drove that valuation. Nothing smart about us. In fact, they didn't care about our clients and our operating systems.
Yeah.
They just wanted to plug them in to their most profitable client and protect their IP. That was my experience. It shocked me. And that's what we've learned over the years and seen thousands of times, where there's something very valuable the seller has, but they don't recognize that because they don't see the world from the perspective of the strategic buyer that's looking at that. And buy versus build, it's always safer for a strategic buyer to buy than build, because building takes time. And remember, it's not their money. The executive just needs to look great and rationalize it. And their buying price is very different from your selling price. I'll also say that.
And it can be times, I would imagine, when you come across companies and you've done a lot, the sort of sort of exercise like the owner's outcome exercise, and you've had a good look under the bonnet, that they probably aren't ready to sell yet. Or they are, but they could be leaving a lot of dollars on the table because
Right.
they haven't got the value drivers in place. So you mentioned a few seconds ago the value max concept, Rob.
Yes.
How does that work? What does that look
Yeah.
like? And how could
Yeah.
a company listening to this podcast take advantage of that?
Yeah. Yeah. Thank you for asking about that, Neil.
Mm,
So Value Max was created because we spent a lot of time with a client who wasn't ready to sell yet
mm,
and gave her all the advising. It's a famous company, so I won't give you the name, but all the advice and counsel to this entrepreneur on how to raise capital, position the business, hire a leadership team. They didn't, they had a coach and we worked alongside of their coach, but they didn't have any idea where this was all going to come from. So we gave them a steer, and the first investor that they talked to that we recommended this the category of investor, she wanted at that time, it's much bigger now, $100 million for the business. It was worth on paper maybe eight. And she got the 100 million from that first investor that came in out of the gate. And we'd done all the work and set it all up. And we were left in left field, and I thought that's never going to happen again. Like we've got to stay involved, and be there alongside of the coach for the client. And so our Value Max process is that we take the mandate for down the road. We build a hockey stick curve of valuation so that which means we're starting at the current value. And then when we don't charge a lot, when the client exits, we win when the client wins. We want them to have a coach in place so that the coach is actually going to be implementing the recommendations that we're making. And then we sometimes will charge for quarterly calls and updating, for getting them out in front of strategics, for making acquisitions. So what we do is there's a whole list. We have a whole one pager that's two columns full of the different types of service. But you can imagine, Neil, if the business is going to be up here in 3 years, 2 years time, and it's here now, what do we need to do to help from the buyer's perspective, the client increase the value of the business? Many times they get excited about making acquisitions, which you help them do. They sometimes recognize that the owner is too involved. They need to build a management team, and we'll make introductions, or the coach can make introductions to well, first of all, actually, they come to understand because we get in front of the strategic buyers whether they're going to value a management team or not. Because sometimes they're going to take the whole team out, and you can actually, by the way, you're going to take the team out. Let me take all those salaries and normalize them times the multiple, please. You need a good negotiator to do that. We don't need your sales team. Sorry, could you say that again? You don't need the sales team. Oh, okay. Well, let me just take that 2 million bucks out and times, the 10 multiple, and that's another 20 million bucks for a client. Thank you. And so understanding what the strategic buyer wants and will value, and then starting to help build that under a consulting agreement that we sign with the sell side for down the road. The longest one I think we've done is 7 years, but we prefer them to be when people think they're going to sell in 5 years, Neil, they normally sell in three. If they think they're going to sell in seven, they're normally selling in four. I mean, if they think they're selling in three, they normally sell in two. Just because once you set your mind to that, the universe aligns. So Value Max is a consulting agreement that goes together with the sell side to help people build the value in the business, and position with strategics properly. Get out and talk to them early, find out what they want.
You mentioned a couple of times there the importance of having a coach through this process. Obviously, I'm a strategic exit coach, but why is having a coach so important in your mind?
It's the job of the owner and the entrepreneur and the leader is to stay focused on the key value drivers of the business. And that's an in the business focus. The on the business focus is where the advisors can come in and provide the perspective of a larger picture where they understand, because they see this across many clients as a coach, what mistakes can be made, what hurdles come up, how to incent people, how to motivate people, how to align them, how to communicate, et cetera, et cetera. And all of that is critical. I had a friend, he was a coach, and he himself had 20 coaches for all different areas of his life because he's like, I don't understand nutrition. I need a nutrition coach. I think I understand sex. But I'd be better with a coach. So
You're
anyway,
right. Well, we've got Wimbledon starting here in the UK this week, and you look at peak performing athletes, and they have 5 or 6 different coaches for totally
yeah,
different areas to be at the peak performance. But let's think about then the importance of actually having an exit advisory team, trusted individuals that come together
yes.
to really complement yourselves at STS, but also that you help and complement the owner and the founder. Where does that advisory team really sort of drive and help you achieve the best outcomes.
Yeah, well, we've just mentioned the coach. Everyone require
Mm.
it's best
Yeah.
advice to have a coach. And a wealth advisor is really important too. And an employment lawyer, which is different if you're going to end up staying than a people often make that mistake. They just hire an M&A lawyer. They don't hire a tax lawyer to help them minimize tax because the net you get is critical, not just the gross. And tax lawyers, believe me, I have a law degree, are very different from M&A lawyers who are very different from employment lawyers. So while it might sound expensive it's well invested money to make sure that you have a tax specialist and that you get there early as 2 years before your exit. You start talking about planning to increase the net proceeds. You need a wealth advisor so that I've seen clients, he sold businesses for, 100 million, 300 million dollars. And I'm calling up to say, hey, let's celebrate. And they're like, I'm like, well, what's wrong? You've got this. Well, I got the money in the bank. I don't know what to do with it. And I'm like, you mean you didn't hire that wealth advisor? And they're like, no, I thought it was for later. And I'm like, well, so there's the lesson, right? Because that's all kinds of people that are not your friends show up when you've got, that much money in the bank who have all kinds of stories of investments and all kinds of things for you because they see the announcement of the deal. You want to start planning these things and have a team well in advance. So a wealth advisor that will help, that's an advanced one, not one locked in to selling you products, but one that you've got, it takes time to find a good wealth manager that's not going to take advantage of you with fees and with their own products. And believe me, it's not the big names. And so that's another whole story. But the coach, the wealth advisor, three different types of lawyers. If you're going to stay, if you're not going to stay, you don't need an employment lawyer. But if you're going to stay, you do an M&A, an experienced M&A lawyer, not just, somebody who's going to be learning on your file because they're doing contracts or something else like that. And a tax specialist lawyer or a tax advisor specialist. There's some of those as well that are more than lawyers. And so I think I've got them all there. I might have forgotten one, and ourselves as the
Yeah.
advisor on the process.
Yeah. Yeah. And again, it's often to your point, a reluctance from their point of view to, invest in the right advisors. But I guess most of the people, if they then look back and what regrets they had is to say, yeah, I probably going with my personal lawyer or trusting there's somebody who was my accountant when I first started out probably wasn't the best thing to do.
I see it all the time. You're absolutely right, Neil. People make such a horrible mistake in hiring their friends that are advisors they've known for years. This is very
Yeah.
specialized, and you need a team that's specialized.
Right, we're coming up to the top of the show now, so just a final few questions, if I may, Rob. Just in terms of knowing what you know now, what would you have done differently in your entrepreneurial career?
I would have done what we advise clients to do now, which I didn't do. I would start to think about an exit option earlier. I didn't. I just kept my head down. And I got whacked by somebody, thankfully, that said, "Hey, your business can be worth nothing with this free trade agreement coming." And I was like, "Whoa, thank you, Trevor," who was his name. So starting early to think about what would an exit look like. And I would say I would spend, which I didn't do, probably 20% of my time on the business and the other 80 in the business so that I'd be thoughtful about, the context of the business in the industry and in the geographies. And that would have served me well. And then I wrote a book, as I mentioned to you earlier. I'm happy to send copies to anybody that's interested. It's digital right now as I continue the editing, but it's What is Your Everest? 7 different types of life planning and 7 different lessons from our 7 summit climbs. What it's really about is planning that next chapter. That's really important. I did it after I sold the business. I would encourage people to do it before because that helps you get over the emotional hurdles of selling your business and when you know what you're going to do. I've heard many wives call me and say, "What did you do? You sold my husband's business. He's sitting at the kitchen table. He has nothing to do. And he's very wealthy and arrogant. And I just want to tell you, I hate you." And I'm like, "Oh, thank you. Uh, Let me talk to him." And so I'm like, I know it's a bit late now, but let's plan this next chapter of your life. where you're going to be full of purpose and full of energy, and you're going to be full of joy because you're focused on what brings you joy, whatever that is. And so planning that ahead of time creates the energy to help get you over the hurdles, and it helps get you through the negotiations and put your deal in perspective. And also, you know what you need for your next chapter. So you know when you sell, there's a big smile on your face because you know now that you're actually, it's not a purpose drop off cliff, which I call it, where people have the purpose of then all of a sudden there's nothing. It's like, wow, I'm going into my next chapter.
Well, that's very generous of you. We will put the link to that book in the show
Oh,
notes.
thank you. Thank you.
And I think one of the things we haven't touched on, maybe for another show, it's more personal, is your story of climbing many of the world's top and highest mountains and all of those things. That what was just to summarize, you're learning from those achievements.
You mean being one of the first amateur couples to climb the seven summits? That
Yeah,
one is, yeah.
yeah.
Um, uh, so this is basically a theme of my book. Anybody listening to this, you can set huge goals above what you think you're capable of. And if they're coming from your heart and they're going to bring you joy, you deserve to do that. And set the goal. And every time fear comes up, because fear will come up, and I use the knife edge ridge of Everest as the analogy in the book. But you recognize four quick steps. You recognize fear is there to help you. Check that you're safe. You probably are. And then focus on that vision. It's so important. Focus on that vision until you get enough energy to push through your fear, and then take the next step now. And just using that quick little through fear, four steps to turn fear into focus, and knowing your vision is so important, and it's your life. So if it's coming up for you from your heart, then don't denounce it and put it down. That's kind of lousy and you feel crap about that. But if you actually set it out there, you write it down, you tell your family, who you know you'll be on the right track when they laugh at you. Imagine me going to my family saying I'm going to climb Everest. They're like, "What? You've never climbed anything in your life?" I'm like, "Yep, I understand." And they're like, "You're an idiot." And I'm like, "Well," and so and then you tell your friends and you tell the world, and eventually things align. And then it becomes really incredibly inspiring and motivating when whatever your dreams are. It's not about Everest as a mountain, it's about it as a big goal. And so I've seen people 80 years old decide they're going to ski with their grandchildren as the biggest thing they never skied. And they go do it. And they call me later and say, I was the happiest day of my life. And I'm like, that's just fantastic. Or they want to go learn a new language so they can communicate with some of their relatives. And it doesn't have to be, it can be anything that brings joy, learning to parachute, or I mean, that doesn't take any physical fitness, by the way, so anyway, whatever people's goals are, I just encourage them to set them. And eventually, and when that includes selling a business, then it will eventually become philanthropic, because you can't take it all with you. And so that's a contribution of setting really big goals as well.
Just as a supplementary question, then, how do you personally go about setting big goals? Now, what process, what playbook do you use to set your own goals?
So there's seven different types of life planning, goal setting in my book, and I'll go through a few of them really quickly. The first one that's really easy is keeping an open list of dreams. Just keep it on your computer or a
Yeah.
paper or in a journal. Journaling is really important. It's not for the faint of heart. If you really journal hard and really
Yeah.
think about your life and think about your fear and think about who you are, if you got a journal there.
Yeah, I'm just looking for it actually. It was a journal that John Ratliff gave me, which
Oh,
is
cool.
John's also one of your partners.
Well, yeah, we sold his business. We sold John's
Yeah,
business for.
yeah. And actually, I started in my 60th year and I said, right, I'm going to do 60 things in my 60th year. And then one of them was to keep a journal for the whole year. But I keep adding to it. I didn't quite fill it out, so I still add to it now. And yeah, so I get it. I get the benefits of a journal.
Yeah. So an open list of dreams is the first one. So keep
Yeah,
an open list of dreams. When you hear of something or see something and you hear the little voice in your head say, I could never do that, but that would be really cool, write it down. So
yeah.
that's the first really simple one. Another one is to imagine you have all the time, money, and energy in the world and you can't fail. There's no limits. Then what would you do? And B, they're two different lists.
Yeah.
Become this and do these things. When I did my first one, it was kayaking over a waterfall and I didn't even know how to spell kayak, and so, but eventually many years later, I did that up in Sweden. And so So if you had all the time, money, and energy in the world, what would you want to do? And you go
Yeah.
away and do that planning. Another one people kind of some people love and some people don't is the deathbed exercise. If you imagine yourself and you have to go walking or in my case it was swimming for many hours to get there because your ego does not want you to do this. It wants to keep living. So if you get to your deathbed and imagine where that's going to be and then looking back at your life, what do you want to see? And that's a real reconciling, moment then. And if you can project yourself there, so you got time between now and then to do whatever it is that's important to you, that's a really cool way of planning. And there's many others I could get into. That's a few of them.
Yeah, or maybe we have another podcast to explore more
Yeah,
about
I'd be
goal
happy to do
setting.
that. Of course.
It's just,
Happy.
yeah, because I think your energy you bring as soon as we start talking about this is infectious, and
Yeah.
and so many people must fall short in their lives of their potential because they don't have goals, they don't have
Right.
anything to aspire to. I think as well as for politicians amongst us, I know it's not a political podcast, but I think globally we're blighted now because politicians don't have a clear vision. They don't have goals for
No.
the country. They don't have a thing that we can all get rallied behind. They don't have that sense of purpose that brings people along with them.
Yeah.
And then I mean, we're just going through now probably our seventh prime minister in the UK in 10 years.
Yeah.
And virtually none of them have really got any sort of
Right.
vision. Anyway, that's another side. Final question. Um, and we're just obviously talking about book. What book are you reading or listening to right
Well,
now? What is
it's really it's I thought about that. It's my book. I'm reading it because it's in its final edit stage, and that's what is your Everest: seven different life planning processes to help and seven lessons from our seven summit climb. And it's like, what is your Everest? What's the next big goal you're going to set? That's what I'm reading right now because I'm doing final edits on it.
yeah.
And I have a stack of books beside my bed. I can't remember all the titles of. Good people send them to me all the time, and I will eventually get to them. That's what I try to do is spend that last few minutes reading a book instead of being on a computer.
Yeah, and then we're talking about books as well. I've just got a book behind, written by one of your colleagues, The Intelligent Exit, and we'll put a link
Mm.
into that. We've already had Mark Carmichael on the show. It's a great show.
Hmm.
But again, there's some great resources around the exit process, and The Intelligent Exit is certainly one
Yes.
of them.
Yeah.
Around that, just a very
Yes.
practical
Mark's book.
guide,
It's a great
very
book, The
practical.
Intelligent Exit. Yes. And then we
Yeah,
have The Extraordinary
yeah,
Exit was just written by Andy Harris as well,
yeah.
with
Okay.
one of our clients. Yeah.
Oh, we'll get that in the show notes as well. So,
Thank
Rob,
you.
so many thanks for joining us on today's
You.
show. It's been an absolute pleasure having you. I've learned so much around this the whole topic. I'm really passionate about, becoming more and more passionate about all the time, and hope our listeners, take out a whole raft of key learnings that's going to help them
Well,
achieve
we're
an
we're
extraordinary.
we're thankful. We're thankful, Neil. We're in 40 cities worldwide. There's hundreds of us available to help, and so we're here whenever your clients are ready. And thank you so much for taking the time to interview me today. I deeply appreciate it. Thank you.